down. You know, I thought one of the most foolish comments that Powell made is he said that he didn't think there was any risk to the Fed
he said it
in
was an
these
outlier.
swaps that they're doing with the banks.
Oh, right.
But, well, because he said the FDIC is insuring the banks. But the FDIC is broke. They don't have any money. The only way they're going to get money is if the Fed prints it. So all of this means more inflation.
Are most banks in the U.S. going to vanish soon? Well, if they are not provided with money, they will be wiped away. But who would give the commercial banks in the U.S. the money they need? Literally, they are dying for money because their reserves have dried up. Today, their money only exists in account books. And guess what? The Federal Deposit Insurance Corporation responsible for these banks' insurance is itself broke. It does not have money left to provide insurance to depositors in the U.S. And what will that bring? Well, perhaps more inflation because the Fed will need to print more money. But how? Well, the chairman of the U.S. Fed, Jerome Powell, will be doing a magic trick which will take everyone into an illusion. But not you. Let's find out what Peter Schiff has to say about inflation, hiking interest rates, and the penniless Federal Deposit Insurance Corporation. Watch the video until the very end to learn about the reality of the commercial banks and the Fed's shady play in them. Let's get started. Jerome Powell recently announced further interest rate hikes, bringing a frenzy in the banking sector. Everyone was surprised, but not Peter Schiff and the owners of the private banks. But before we know why Peter Schiff was expecting such an unnecessary rate hike, let's first know what would be the result of this rate hike. Andy Brenner, the head of international fixed income at National Alliance Securities, said that Jerome Powell made a huge mistake by increasing the interest rates. This rate hike would bring more burden on the commercial banks. Jerome Powell said 6 more banks are on their way toward a meltdown, and this rate hike will boot that fall. Not only that, but deposits in banks are going to get low, which is why the 3-month Treasury yield has dropped sharply from 4.74% to 4.25% and further came down to 3.93% within a single day. Listen to what Andy Brenner said.
Liz, he was concerned about the message he was saying. I think he made a huge mistake. There's no question the banking system's in terrible disarray, and it's just going to get worse. The negative arbitrage between going to Treasury bills at 4.80 or money funds at 4.5 and banks paying 1 to 2%. Banks are going to continue to lose money and lose deposits. It's just going to get worse and worse and worse. And he did say that 6 banks are in trouble, or he used some kind of specific Fed verbiage to say that. So I think the banking system's going to get a lot worse, which is why you saw the 2-year yield go from 4.25 around noon to 4 1/8 when you just said it as you spoke, down to 3.95. And I think that's going to continue to happen. And you saw the 2-10 yield curve right at the beginning go to minus 63. And then last I looked on my phone here was minus 46. So I think that tells you that steepening move that we're seeing tells you that there's a lot of problems out there and the Fed's going to have to ease. And the markets do not believe that the banking system.
Here's a little reminder to like the video if you are enjoying it. And if you don't want to miss videos about the evolving economics and the financial order, subscribe to our channel. Let's continue now. But Jerome Powell said something surprising. He would lower interest rates to 2%. Is it ever going to happen? Well, the interest rates are approaching 6% now, which shows how vulnerable the financial situation is. Bringing interest rates down could be in question if we were not seeing commercial banks melting and in trouble. But they really are in need of money, which will force the Fed to print more money. And you all know, printing money brings more inflation. To control that inflation, the Fed increases interest rates, not decreases them. First, listen to what Peter Schiff said about interest rates.
Now, we're not going to get anywhere near 2%, maybe not even in our lifetimes. That's how far off Powell is. You know, the reason that he hiked rates, he's borrowing a trick from a magician. It's called misdirection. Because with the one hand, he's raising rates, but he's got another hand behind his back where he's just returned to quantitative easing. He's actually creating inflation. He's not fighting it. And I thought one of the most ridiculous comments he made is when he was kind of asked to explain that, and Powell denied that the Fed was back to quantitative easing. And the reason he said that it's not QE is his explanation was when the Fed was printing money and buying bonds because it wanted to bring interest rates down, that was QE. But now it's printing money and buying bonds, but it's doing it for a different reason. So even though it's exactly the same, it's not QE. So when you create inflation because you want to, it's quantitative easing. But when you create inflation because you have to, then I guess, he pretends he's not doing it. But he is creating inflation. And so what Powell is now doing is pouring gasoline on a fire. He's just pretending that he's trying to.
Peter Schiff completely ruled out the assumption that interest rates will ever come down to 2%. He said that perhaps interest rates are not coming to 2% in this lifetime. But why? Well, Peter Schiff exposed what next sting Jerome Powell is going to hit. Peter said Jerome Powell was performing a delusional magic trick to fool everyone. Apparently, he is increasing interest rates to bring inflation down. Everyone starts to think that, at least, the Fed is trying. But nobody knows that this is just an illusion. Secretly, at the same time, the Fed is printing more money, making the interest rate hike useless. Peter said that to make things normal, interest rates are increased while pausing the money supply. However, when interest rates are increased and more money is printed, it just creates devastating inflation. Financial status keeps the same, but now, people have to pay more for goods and also more interest for things they want to buy, taking loans. It creates an ultra-inflation atmosphere. Peter said that earlier, the Fed was printing more money so it could buy the bonds. In doing so, it was thought it could bring interest rates down. However, that's not how it works. When more money is printed and bonds are bought, interest rates can be brought down, but inflation is created as a byproduct. Now, to bring inflation down, interest rates have to increase. You see, everything was done to bring interest rates down, but they are still high. However, there is more money supply than before. And it doesn't happen without reason. The Fed intentionally does this drama. It tries to show that the money supply had to be increased. People think it is good for them, but the real benefit goes to giant companies. This time, it's the commercial banks that are going to get an advantage. In playing a whole drama, the Fed will print more money. This will be done to offer the banks with money they need. Otherwise, they are near melting down because all their money is blocked in non-performing or failed loans. The Fed has to risk itself and, thus, the entire U.S. economy to offer help to these commercial banks. But is the Fed free from all risks? Well, listen to what Peter Schiff has to say about that.
I think this is the pivot. I mean, it's a soft pivot, but he made it clear that he eased his forward guidance. So I think the next move from the Fed is going to be a cut. But inflation is going to be much higher than it is right now when the Fed does that. So the Fed is going to have to give up this pretense that it ever has a chance of bringing inflation down. I thought one of the most foolish comments that Powell made is he said that he didn't think there was any risk to the Fed
in
these swaps that they're doing with the banks.
Oh, right.
Well, because he said the FDIC is insuring the banks, but the FDIC is broke. They don't have any money. The only way they're going to get money is if the Fed prints it. So all of this means more inflation.
Peter said Jerome Powell made a foolish comment when he said the Fed was not at risk. He said, which has to be the case, that the Federal Deposit Insurance Corporation will insure the banks and the deposits. However, Powell does not know that the FDIC has nothing left. It's broke, and it holds no money at all. Banks don't have money today, and the account holders want their money back. The banks had the depositors' money which they offered in loans which they today cannot get back. To save everyone, the FDIC is supposed to offer money to the banks so the depositors can have their money back. But the irony is the FDIC does not have money itself to do the saving job. Now, the Fed has to offer money to FDIC by printing more money. This will bring in more inflation, forcing the Fed to increase interest rates further. Interestingly, the money which the banks will get will be used to offer more loans. But high interest rates will make loan repayments impossible, and the banks will be once again near melting. That's the perpetual dilemma the Fed and the commercial banks will always face. Would you think more banks in the U.S. are going to melt down? Or would the Fed provide them with money and usher in more inflation? The Fed has got two choices: lower the inflation and not provide money to these banks, or print extra money and bring devastating inflation once again. Tell us what the Fed will do. Will it save the common American or the gigantic banks? Do you want to watch more videos like this one? If yes, please like and share the video and subscribe to our channel for more videos on the latest economics and financial news. Until the next video, stay tuned.